The Maverick Podcast, Gold's 45-year comeback. Why everyone's suddenly obsessed with the yellow metal. Welcome to the Maverick Podcast, the show that dives deep into the stories behind the numbers, the strategies behind the headlines, and the trends that matter to investors who think differently. I'm your host, and today we're unpacking one of the most explosive rallies in financial markets right now. Gold is up 25% year-to-date. And get this, it's officially back at its all-time inflation-adjusted high, smashing through a ceiling that held for 45 years. Yes, you heard that right. It took nearly half a century, but gold just reclaimed its crown. Today, we're going to break down what's behind this stunning move, what history tells us, and why this rally might still have legs. Let's dig in. Let's start with context. The last time gold hit an inflation-adjusted peak was way back in 1980 during the aftermath of the oil shocks and a brutal inflation cycle that pushed the price to nearly $850 an ounce, the equivalent of over $3,200 today when adjusted for inflation. Fast forward to 2024, gold has now matched and surpassed that peak, and we're not just talking about a quiet climb. This is a roaring surge, a more than 25% gain since January, putting it at the high end of historical performance. In fact, over the last 20 years, gold's average 100-day return has been just plus 1% with a standard deviation of 10%. That means this current move, a plus 26% surge over the past 100 days, is a classic 2 standard deviation event. Statistically rare, historically meaningful. Here's where it gets spicy. If you've been holding long-duration bonds over the past few years, brace yourself. Since March 2020, gold is up 110%. The iShares 20-plus-year Treasury ETF TLT is down 43%. That's not a draw, that's a beatdown. Gold has absolutely crushed bonds as a store of value and inflation hedge in this cycle. And investors are taking note. The main gold ETF GLD just crossed the $100 billion mark in assets under management, a milestone that cements gold's return to the institutional spot. Let's talk history. There have only been a handful of times over the past 20 years when gold has rallied this hard in such a short time frame. And each time it wasn't random, it was crisis-driven. 1. 2005-2009, the speculative frenzy and collapse of the U.S. housing market. 2. 2011, the Greek debt crisis. 3. 2020 COVID-19 pandemic and global panic. Today, the world is facing a cocktail of uncertainty, sticky inflation, geopolitical risk in the Middle East and Eastern Europe, central bank credibility concerns, and let's not forget a $34 trillion U.S. debt pile with rising servicing costs. That's why gold is rallying now, and yet according to DataTrek, this isn't even the most extreme we've seen. Back in January 2008, gold surged plus 38% over 100 days. In August 2020, it did plus 37%. So in theory, if gold hit $3, $700 per ounce, it would match that. Plus 40% panic level asterisk. Right now, we're sitting just 10% below that threshold. While gold is flying, digital gold aka Bitcoin has been left behind recently. Gold ETFs are seeing steady inflows. Meanwhile, Bitcoin ETFs are cooling off. And when you zoom out on the gold to NASDAQ ratio, gold is beginning to break out of 4-year range, a potential signal that hard assets are coming back into favor even against tech-heavy equities. Plus, there's the geopolitical angle. Gold is non-sanctionable, non-confiscatable, and globally liquid. In a world where capital controls and currency weaponization are real threats, that's no small feature. Now, some technical analysts are sounding the alarm. Gold is overbought. Sure, the RSI and momentum indicators are flashing hot. But here's the thing. Overbought markets can stay overbought far longer than most investors expect. And the GVZ Gold's Volatility Index just exploded higher, showing an options market bracing for more movement, not less. It's not fear, it's demand. So where does this all leave us? Gold is reclaiming relevance. It's outperforming traditional bonds and competing with tech stocks. It's acting like a crisis hedge, geopolitical hedge, and a liquidity hedge all at once. If you're a portfolio manager, family office, or just a savvy individual investor, ignoring this rally might mean missing out on a generational shift in capital flows. The question now isn't why gold rallied. The question is what happens when central banks, sovereign wealth funds, and institutions fully return to gold in size. Because if history's any guide, This rally could just be getting started. That's it for today's episode of the Maverick Podcast. If you enjoyed this breakdown, hit that subscribe button, share it with a fellow investor, and don't forget the market doesn't reward the obedient. It rewards the informed and the bold. Stay sharp, stay Maverick,